Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a series that aims to focus on the trend lines rather than just the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
It's February, the gym parking lot is thinning out, the salads have quietly been replaced with cheeseburgers again, and in many portfolios, something very similar is happening. We start every year with great intentions, right? This is the year that I stay disciplined. I won't react to every single headline. I'll keep the long term in mind. And then February shows up. Markets move a little bit, headlines get louder, and a hot theme starts running. Your buddy down at the golf course brags about some position that you don't own, and then suddenly, those ironclad New Year's resolutions, well, they start to look a little bit negotiable. So in this episode of the Trending Report, we're going to talk about what really happens in February, how old habits sneak back into investor behavior, how love and fear quietly drive a lot of portfolio decisions, how the fear of missing out convinces people to abandon good plans, and most importantly, the basic framework to move from feelings to formulas. Let's start with a pattern that every investor will recognize, which is the January is the resolution phase. You sit down and you say to yourself, I understand volatility is normal. I'm not going to react emotionally. I'm thinking about the big picture this year. And you mean it. In that moment, you're calm. The market maybe hasn't done anything crazy yet. And the plan on paper, well, it looks really good. And then February rolls around. Maybe the market has a rough week. Maybe a particular sector or theme suddenly takes off and dominates the headlines. Maybe we get a surprising economic data point and the media does what it does best, overreact loudly. And then that's when second guess season begins. Advisors start hearing things like, are we sure we're positioned correctly? My friend is in, insert hot theme here, and they're doing really well. Should we be in that too? Should we be more aggressive or more conservative? Or maybe we should just go to cash until things calm down. It's the investment version of the February gym dilemma. I know I said I'd be there 5 days a week, but it's cold today and I'm tired. And maybe I'll just start again in March. The issue isn't that investors are irrational. The issue is that they're human. And humans have a pattern, especially around money. Left to our own devices, we cycle through a predictable loop. We plan, we feel good, we encounter volatility, we question that plan, we question everything, and we abandon it at the worst time. Then we repeat. That sounds familiar. It's probably because you've seen it more than once. Now, since it's February, let's talk about two emotions that show up most often in markets: love and fear. On the love side, well, investors fall in love with a stock or a sector just because it was good to them, 3-4 years ago. They're attached emotionally, and even when the fundamentals shift, they won't let go. That's no longer an asset allocation conversation. That's a breakup conversation. And those are always messy. The fear side? Well, fear shows up as a desire for the sidelines and ultimately results more often than not in exiting a strategy at the worst possible time. Let's wait for a better entry point. The problem? Well, calm markets are a myth. They only exist in hindsight. In real time, there's always a Fed meeting, there's always an election, there's always a geopolitical headline to be afraid of. If investors wait for a moment when there's nothing to be anxious about, they'll probably be waiting on the sidelines through a lot of potential growth. So you get the emotional tug of war here. You love the winners and don't want to let go. You fear the losers and want to avoid any discomfort. And the combination of the two emotions, They often lead to buying high, selling low, and second-guessing everything in between. Emotions aren't the enemy. Letting emotions drive the decision is the problem. So let's talk about the loudest emotion in particular, FOMO, or the fear of missing out. FOMO is incredibly powerful because it just doesn't say you might lose money if you're wrong. It says everyone else is getting rich without you, and you're the only one missing it. You've probably seen it play out. A theme takes off, returns look amazing, the media starts running why you should be invested in X theme right now, whatever it may be. And even the most rational investors start thinking, should we be invested in that too? The temptation to chase, to ignore the original plan, to make a big sudden move into whatever's hot right now, that's how a lot of investors end up overexposed to themes or trends that later turn out just to be a fad. So what's the alternative? The alternative is moving from FOMO to a formula. Instead of saying, I feel like we should buy this, you build a process that says, if X and Y conditions are met, we increase exposure. If Z happens, we exit. That's formulaic investing. It doesn't mean that we ignore the trends. It means that we follow them in a structured way. Rules, risk control, exit criteria, all baked into the approach. Formulaic strategies can do things like increase exposure when a trend is strong and confirmed, not just when it's in the news. They can gradually reduce or exit when the evidence changes instead of waiting until everybody else panics. They can adjust based on volatility rather than based on who's shouting the loudest on TV that week. Now, is it perfect? No, nothing is. But it does something incredibly valuable. It removes emotion from the decision, even if it can't remove the emotion from the human. You can still feel FOMO. That's human nature. You just don't have to act on it because the formula, it already knows what it's going to do. We've all felt the February fade. But here's the good news. You don't have to be a perfectly rational robot to be a successful investor. You just need a process that's stronger than your impulses. Formulaic investing replaces the I feel with we've decided. It replaces let's react with let's follow the framework. Maybe we should chase this with here's how we systematically participate in trends. In a month dedicated to relationships, help your clients fix their relationship with the market. Move them away from the impulses of its complicated status and move them towards one that's grounded in discipline and clarity. Thanks for joining this episode of the Trending Report. If you recognize yourself in any of these stories today, don't worry, you're in good company. Just make sure that your next step isn't guilt. Make sure it's discipline. Stay curious, stay disciplined, and I'll see you in the next episode.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.